Ever feel like your financial plan is kind of a tiny boat in a really stormy sea? Today, we're doing a deep dive into building what's called an all-weather portfolio. Basically, a strategy designed to, weather any market storm, inflation, economic downturns. We're digging through insights from investment giants like Benjamin Graham and John C. Bogle, some really powerful stuff here.
Yeah, and our mission really is to distill the core principles,
Mhm.
the things that empower you to invest confidently. It's about focusing squarely on what you actually can control.
Okay, yeah, let's unpack that. I mean, the very idea of an all-weather portfolio,
Yeah.
it sounds really robust. Where do we even begin trying to build something like that?
Well, the bedrock, and our sources really emphasize this, it starts with two main things. First, just acknowledging that all investing carries risk. There's no escaping it. And second, adopting a truly long-term strategy.
Okay, so accept risk, think long-term.
Exactly. It's not about avoiding risk, but managing it, mitigating it through smart allocation.
Yeah.
And that long-term commitment. It's not just about being patient. It actually enhances returns, reduces risks,
Yeah.
and importantly, it magnifies the baneful impact, as they say, of investment costs.
Right. So looking past the daily news ticker, basically, letting the long game play out. But what does that long-term commitment practically mean when we're actually deciding where to put our money?
It really boils down to intelligent fund selection.
Mm-hmm.
Your focus has to be, well, quoting here, not on the market's short-term direction, nor on finding the next hot fund, but on risk, cost, and time, all of which the investor can control. That's the key.
That's a powerful distinction.
It is. And, remember that phrase, the greatest enemy of a good plan is the dream of a perfect plan. Plus, a crucial thing people forget, markets do not always rise. Sometimes they go down, sometimes sideways.
That long-term focus definitely cuts through the noise.
Okay. But even with that clarity, the sources really hammer home one factor that can just quietly sabotage everything: costs. What do Graham and Bogle tell us about the true impact of costs?
Oh, costs are. Yeah, they're the silent saboteur. Absolutely. It's so easy to overlook small percentages, right? But these tiny fees, they're not just eating today's returns. They are compounding the loss of your future wealth. It's staggering and often unnoticed.
How staggering are we talking?
Well, think about an aggressively managed fund. The total charges could be as high as 3% a year, maybe even more sometimes. Now, contrast that with a simple market index fund. Their costs can be held to 0.20% of assets or even less.
Wow, okay, 3% versus 0.2%. That is a massive difference.
It's huge. And the research consistently shows, across the board, lower costs they lead to higher returns. It's almost unavoidable. They call it the tyranny of compounding. Small cost differences create staggering differences in capital accumulation over decades.
That's not just the main fee, right? No, exactly. You've also got hidden stuff, like portfolio turnover costs in active funds. That can approach, believe it or not, 100% annually. It's like this hidden tax from all the buying and selling, erodes gains constantly.
Okay, so if active management is so costly, what's the simple solution? What do Graham and Bogle point to?
Indexing, simple as that. An index fund is just a broadly diversified portfolio, typically run at rock bottom costs. It just buys and holds the stocks or bonds in a particular market index. No trying to pick winners.
And big names endorse this.
Oh, yeah. People like Peter Lynch, Charles Schwab. Schwab even said something like only about 1 out of every 4 equity funds actually outperforms the stock market. And think about the original Vanguard S&P 500 index fund. Over 15 years, it outpaced 97% of all funds on an after-tax basis.
97%.
Mostly because of those low costs, yeah, and also because they're very tax efficient. Less trading means fewer taxable events for you.
Okay, so low cost, passive indexing, that seems central. But how do we make it truly all-weather? What about handling different conditions like inflation?
All right, good question. Balance is vital. The sources constantly talk about the importance of balancing an investment program between stocks and bonds. That core diversification helps handle general market ups and downs.
Stocks and bonds, got it.
But yeah, for inflation specifically, Treasury inflation-protected securities, or TIPS, are an excellent tool.
TIPS, how do those work?
Well, their principal value actually adjusts with inflation. So inflation goes up, the bond's value goes up, and then the interest you earn is based on that adjusted amount.
Huh. So their value literally tries to keep pace with rising prices. That's pretty smart.
Exactly. They're seen as ideal for a tax-deferred retirement account, like an IRA or 401k. And you should really view them as a permanent, lifelong holding, not something to trade in and out of.
Makes sense. How much should someone consider?
The suggestion is maybe allocating at least 10% of your retirement assets to TIPS. It's seen as an intelligent way to keep a portion absolutely safe, beyond the reach of the long, invisible claws of inflation.
Okay, so let me recap. A thoughtful mix. Low-cost, diversified index funds, balance between stocks and bonds,
Mhm.
and then a specific slice, maybe 10% or more, in TIPS for inflation. That sounds like a plan you could actually stick with.
Precisely. It's durable. And remember that idea of mean reversion. Returns in different sectors eventually tend to revert back to the average or even below. So yesterday's hot fund is often tomorrow's loser, which just reinforces the value of being consistent, diversified, and low cost rather than chasing trends.
So wrapping this up, what does this all mean for you, the listener, building your own all-weather portfolio?
I think it means embracing the gift to be simple, as one source puts it. Prioritize controlling costs, being tax efficient, and just having that long-term discipline. The real goal is durability through market cycles, not, trying to get rich quick or speculating.
It's a really powerful case for patience and simplicity, isn't it? Which leads to an important question for you listening. Given all this compelling evidence for low-cost indexing and long-term discipline, what's one concrete step you might take, maybe even this week, to make your portfolio just a bit more all-weather? Something to think about.